Welcome back, everybody. The S&P 500 and the NASDAQ are at all-time highs, and of course, that is people preaching caution. But part of the challenge with these things as everyday investors is knowing what we should actually do about it. Do you sell your stocks? Do you keep buying stocks? Do you only buy cheap stocks? I mean, it's not really obvious how to approach this, and making the wrong decision can really cost you a lot. So in this video, we're going to talk about the market's current level compared to historical averages, what are some of the things that could explain why it's happening, and what we should actually do about it. So let's go ahead and get started. Now, obviously, there are definitely signs that the market is a little hot. I mean, we've talked about stocks like Cloudflare, which is trading at 150 price to cash flow, or even stocks like Robinhood trading at a 90 price to cash flow and a 60 PE. Or, of course, Palantir trading at a 290 price to cash flow and a whopping 667 price to earnings. And more people are starting to talk about it. Even CME Group is talking about price to earnings ratio of U.S. equities is at a historic high. And looking at historic price to sales ratio shows that we're running really hot. And if we take a look at the classic Shiller PE ratio, you can see that currently we're at a rate that's only been higher back in July of 2021 and October of 1999. And obviously, both of those times happened before a big crash, right? So it's natural for people to think, look, we're approaching the same levels that we have in the past whenever the market crashed, so maybe that's going to happen again. But I do think there are a couple things to consider whenever we're looking at historical averages that at least partially explain what might be going on. And number one is the fact that tech stocks now dominate the indexes, with the top 8 companies, if you only count Google once, in the S&P 500 are tech companies that tend to trade at higher valuation multiples. And in some of those cases, you could say that they deserve a higher multiple due to the strength of the company, the strength of their balance sheets, and their dominance in multiple markets. But obviously, that's not going to be the case everywhere. I mean, we talked about some of these companies already with Robinhood, Cloudflare, and Palantir, or even companies like Snowflake trading at an 86 price to cash flow. So obviously there's more to it than just tech stocks dominating the index now. But another thing that we need to consider is the fact that monetary policy has changed a lot over time. Now, one of the things that always gets me whenever people show historical charts like on 100-year timelines, because most of the time they leave out a very important change that happened in 1971, because that's when we moved off the gold standard, and since then the money supply has risen rapidly over the years. Now, I know I'm oversimplifying this by a lot, but the more money that's out there in the system, the more that kind of goes into assets, and asset prices tend to rise. Now, of course, that inflation is also present in the revenues of the company. So in theory, the multiples should kind of even out a little bit, but still, I think what you're seeing is more of that money going into the market winners who dominate the index with higher multiples, and here we are. But lastly, a smaller item that I think is still relevant that I don't hear people talk about a lot is the rise of automatic investment, especially in 401ks. So every 2 weeks, people get paid, money goes into their retirement account automatically. It automatically buys whatever they're wanting to invest in, and that is consistent buying pressure that's totally insensitive to price. Like, it doesn't look at it at all. And that particular behavior has grown significantly over the past 50 years. So my point is, some things have definitely changed, including important behaviors both in how we address monetary policy, but also in how the majority of people are investing. So just looking at a historical price to earnings or even price to sales chart doesn't quite tell the whole story. Now, obviously, one exception to that is the Shiller PE ratio because it is cyclically adjusted, but still, there are companies that are trading at crazy valuations right now for sure, so there is some cause for concern, but the challenge is that people are always saying this. I mean, we just talked about it on this channel a couple months back when it was in the news, and then even back in March, talking about the possibility of a flat decade, or even all the way back to October of 2023, because people like Paul Tudor Jones were saying the market was getting toppy back then. So then what should we be doing about this? Because people are always predicting what's going to happen. And as investors, it's just hard to know when something's going to play out the way that people say or not. Because anyone who was bearish on the market or tech stocks back in the end of 2023 has probably severely underperformed the market and missed a great opportunity to make a lot of money. I mean, it's just the truth. But then if we get another downtrend like we had in 2022 or even worse, then tech stocks are going to get crushed. which for me personally means that my portfolio is going to get absolutely crushed. But even then, it's not something that I really worry about because my approach isn't to predict exactly what's going to happen because I understand that that's impossible. And if you've watched the channel for a while, you know that I talk about everything in terms of probabilities. So my approach is to structure my portfolio in a way that I'll be okay if the market goes down by a lot or goes down for a while, but still give myself an opportunity to benefit if it keeps going higher. But what does this actually mean in practice? Well, to me, it means things like buying companies that you plan to hold for longer than 1 or 2 years, and maybe even longer than that. But I think the point is that you want to hold companies to where you have a long-term outlook for the company so that you're not so much worried about what happens in the short to medium term. But then also you want to ensure that your risk level matches your tolerance and timeline. And this should always be true, but especially if you think that the market is getting a little bit overextended or too hot, you don't want to be caught kind of with higher risk levels than you're prepared for, especially if you're getting close to retirement or you're just afraid of losing that capital. And then next, hold companies that you actually believe in. Now, I know this seems super obvious, right? Everyone's like, well, I wouldn't have bought it if I didn't believe in it. But this is a great example of why I personally don't focus on valuation as a primary consideration, because to me, valuation is not a good enough reason to buy a stock. I need companies that I'm confident in no matter what, not just companies that I thought were cheap enough to buy, because even cheap companies go down whenever the market goes down. Now, of course, ideally you want to buy companies that are great and trading at a good valuation, but a lot of what I see is people focusing on the stocks that are all of a sudden cheap and then kind of convincing themselves that it's also a great business. And I just don't really agree that that's the right approach, at least for me. And lastly, if you think the market is toppy and valuations are crazy, then maybe slow down your buying schedule a bit and simply put your investment money into cash until prices and valuations come down to a more attractive level for you. And I've actually been doing this for a little while. Even though I just spent some money on a very expensive stock, I still have about 10 grand or so kind of waiting in cash just to kind of see what the market does. Plus, as we get into earnings season over the next few weeks, the likelihood of a big drop in a company that you're interested in is very possible. I mean, it happens all the time. So overall, my point with this is that people spend a ton of time trying to predict exactly what the market's going to do. And in my opinion, that's just a waste of time. Now, if you're the type of person that can make wide sweeping decisions like, hey, I'm going to pull all my stocks out of the market because it's about to go down, more power to you. But I think for most people, the better approach is to simply structure your portfolio in a way that you're comfortable, even if your stocks happen to go down 20, 30, or 50%. Because you have a longer timeline for investment or because you believe in the long-term outlook of the companies that you hold. And just don't worry if the market ends up trending down for a bit. Because again, trends can last longer than we think, both up and down, and I don't see the money supply going down anytime soon, for better or worse. Now, if you're struggling to understand why some valuations for stocks seem to make more sense than others, you can watch my recent video about the topic by clicking this video right here. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see you on the next one. Peace.